For many Americans, buying a home in 2025 feels more out of reach than ever before. Even as inflation has cooled and wages have risen slightly, housing affordability remains near historic lows. To understand why, we need to look at what actually changed and what didn't in the U.S. housing market over the past few years. After the pandemic, U.S. home prices surged at one of the fastest rates in modern history. Low interest rates, remote work, and a wave of demand pushed prices sharply higher between 2020 and 2022. Even though price growth slowed later on, home values never meaningfully came down. In many cities, they simply flattened at much higher levels. At the same time, mortgage rates moved in the opposite direction. In 2021, the average 30-year fixed mortgage rate was below 3%. By 2024 and 2025, that number climbed to around 5 to 7%. This single change dramatically reshaped affordability. Higher rates don't just raise monthly payments, they permanently increase the total cost of buying a home. A household buying a median-priced home in 2025 is paying hundreds, sometimes thousands, more per month than a buyer just a few years ago, even if the home price itself hasn't increased much recently. Mortgage payments are now consuming a far larger share of household income than in the past. While wages have increased since the pandemic, they have not kept pace with housing costs. Median household income has grown gradually, but home prices and interest rates moved much faster, creating a widening gap between what people earn and what it takes to afford a typical home. Historically, housing affordability improves when one of three things happens: home prices fall, incomes rise rapidly, or mortgage rates drop. In 2025, none of these conditions are strongly in place. Home prices remain elevated due to limited supply, as many homeowners who locked in ultra-low mortgage rates years ago are unwilling to sell, reducing the number of homes available on the market. New construction hasn't been able to fully close the gap, especially in high-demand metro areas. Meanwhile, interest rates remain high as the Federal Reserve keeps policy tight to prevent inflation from returning. Even small rate cuts wouldn't dramatically restore affordability unless rates fall much further, which remains uncertain. This environment has been especially harsh for first-time buyers, who don't have home equity to roll into a purchase and therefore face the full weight of high prices, high rates, and stricter lending standards. As a result, the average age of first-time homebuyers continues to rise, and homeownership rates among younger Americans remain under pressure. What hasn't changed is the fundamental structure of the U.S. housing market. Zoning restrictions, limited urban supply, and long construction timelines still constrain how quickly new housing can be built, and these are slow-moving factors that don't adjust easily. Even when affordability worsens, what has changed is the cost of money. The housing affordability crisis of 2025 is less about runaway prices today, and more about the interaction between past price increases and today's higher interest rates. Even a stable housing market can remain deeply unaffordable when financing costs double. Looking ahead, affordability may improve, but likely only slowly, through a combination of modest price adjustments, gradual income growth, and eventually lower interest rates. A rapid return to pre-pandemic affordability levels appears unlikely in the near term. For millions of Americans, housing has become not just a place to live, but a long-term financial challenge. And for investors and policymakers alike, the 2025 housing affordability crisis is a reminder that price stability alone does not guarantee access to homeownership.